Assalamualaikum and hi, my name is Nur Alia Maisara binti Muhammad Rashid and my metric number is F1059. I will presenting about the definition of borrowing costs under Mfrs 123. So, the borrowing costs are interest and other costs that an entity incurs in connection with the borrowing of funds. And a qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. So, as the explanation, borrowing costs refer to the interest and other related expenses that a company incurs when it borrows money. These costs can include interest on loans, finance charges on leases, and other similar expenses directly related to borrowing funds. Now, not all assets are treated the same when it comes to borrowing costs. This brings us to the concept of a qualifying asset. A qualifying asset is one that takes a substantial period of time to be prepared for its intended use or for sale. As an example, can include large construction projects like buildings, manufacturing plants, or even long-term development projects. In accounting, borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset must be capitalized. In other words, they are added to the cost of the asset rather than being expensed immediately. This aligns the cost of borrowing with the period in which the asset will provide economic benefits. So, to sum it up, borrowing costs are the expenses tied to financing, and the qualifying asset are those that take time to be made ready. And when these two intersect, the borrowing costs may become part of the asset's value on the balance sheet. Next, for the objective of borrowing costs are to prescribe the accounting treatment for borrowing costs, and the standard requires the capitalization of borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset. So, as the explanation of objective of the standard on borrowing costs, the main purpose of this standard is to explain how to handle borrowing costs in accounting. It requires that if a company borrows money to get, build, or produce a special type of asset they call a qualifying asset, the related borrowing costs, like interest, must be included as part of the cost of that asset. This is called capitalization. By doing this, the financial statements will show a more accurate value of the asset and give a clearer picture of the company's financial position.
Assalamualaikum warahmatullahi wabarakatuh. My name is Mfrs and my matrix number is F1038. So today I want to explain about recognition. Borrowing costs directly attributable to the acquisition, construction, or production of a qualifying asset must be capitalized as part of the cost of that asset. Qualifying asset is an asset that takes a substantial period of time to get ready for its intended use or sale. For example, building and manufacturing plant. For other borrowing costs, it should be recognized as an expenses in the period in which they are incurred. Thank you.
Hello, my name is Hasha binti Hamid Zulkarnain and my metric number is F10699. And as for today, I will be explaining about initial measurement. When a company borrows money to build or buy something big, like a factory or a building, it can include part of the interest it pays on those loans into the cost of the asset. But this is only applies if the asset takes a long time to get ready for use or sale, and we call this as a qualifying asset. Now, if the company uses general loans, it has to calculate an average interest rate from all those loans. This average rate is then used to figure out how much borrowing costs can be added to the asset. However, if there are loans taken just for that specific project, we don't include them in generous. We don't include them in average. We only focus on general borrowings here. And finally, we have to make sure the amount of borrowing costs we include doesn't go over the actual interest the company paid during that period. So, in short, We calculate an average rate from general loans, apply it to the asset cost, and make sure not to overcapitalize it.
In financial statement, particularly in the balance sheet, capitalized borrowing costs are not shown separately. Instead, they are included as part of the cost of qualifying assets such as property, plant, and equipment or investment property. The borrowing and financing used to finance these assets are shown under liabilities. These liabilities are usually classified into two main categories, namely non-current liability for long-term borrowing and current liability for short-term borrowing or the portion of borrowing that is due within 1 year. In the statement of profit or loss, interest expenses or borrowing costs that are not capitalized will be presented as part of financial costs or interest expenses. Typically, the information is presented under the finance cost section, which is usually collected after operating profit. In some cases, this finance cost may be combined with or deduction from finance income to show the net amount as either net financing cost or the finance income. This presentation help users of financial statement to understand the net impact of financial activity on a company's profit or loss for a given period.
And the last one for today, we have disclosure, which means companies need to clearly show how much borrowing costs they have capitalized during the accounting period. This helps users of the financial statement to understand how much of the interest was added to the cost of assets. They also have to disclose the capitalization rate, which is the average interest rate used to calculate the borrowing costs. And if the company's accounting policy for borrowing costs is important or different from the usual, they must explain that too. All these disclosures are important to ensure transparency and consistency in financial reporting. That's all from me. Thank you.